So thanks for spending your Tuesday or Thursday or what is it, Wednesday evening with me. That's good. That's a good start. We are going to talk about the fun subject of capital planning. But what I wanted to do first was just get a quick poll in the room. How many of you guys are in the New Ventures BC competition? Nice. Okay, so that's great. So you guys are the people I want to talk to. So a couple of notes just before I begin. I have an hour, and Angie, if you could tell me when my hour is almost up, that would be fantastic. Thank you. I tend to get carried away. I have a semi-agenda, but what I like to do is focus on what you guys want to hear. So what I'm going to do is I'm going to go through a couple of slides, tell you some basics about how I look at capital planning and think about it, and then I'm going to open it up to questions. And if there's 2 questions, then we'll be home early. If there's more, I'm happy to spend as much time as needed answering the questions. My philosophy on questions, even though we're on camera, is there's no dumb questions. So if you don't understand something, let's pretend this is Magic Circle, and you can just ask me to explain it to you, and I'll try to do so. If I try to explain it to you once and you don't get it, I'm not going to try to explain it again in front of everyone else, but I'm happy to do so after. So I'm kind of like remedial math can happen after the conversation that we have. Is that cool?
And then just a reminder, I think we're going to turn the mics down a little bit. Thank you. We are webcasting, so let's wait a minute so we can turn this down. We're webcasting, so we need to ask your questions into the microphone.
I'll repeat the questions.
Great. And if you're watching online, you can tweet at NVBC if you have a question. Thank you.
Excellent. My Twitter handle is @JonathanBixby. My marketing folks always make me add that because that's the cool thing to do. All right, so let's talk about me because that's fun, or the antivirus on the computer. So let me give you a quick background, super fast. I've actually am in an interesting position to talk about capital planning because I've started a couple of different businesses with different capital requirements. So the first one was Iron Point. Iron Point was started in 2001. Iron Point was completely self-funded. Put $5,000 of my own money into that thing, and about 30 months later had a pretty great exit to the Active Network, which was a publicly traded company, and they just went private. So I have done the completely no outside capital route. I also raised the largest Series A angel round in Canadian history with Strange Loop Networks, which was $11.5 million, and went on to raise $21 million for that company. So I know a little bit about raising big piles of money, and now I get to give money out. So once that company was acquired by Radware, I took 9 months off and traveled the world with my kids, and then I came back and started investing. So what I do at GrowLab is I'm the executive director. For those who don't know what GrowLab is, it's Canada's best, and I'm going to say that unabashedly, Canada's best accelerator. We have invested in 27 different companies, and we provide a 3-month acceleration program for those companies, and we also provide financing for those companies. So if any of you are interested in GrowLab, please come talk to me. So we invest in great companies, and what I've learned through bootstrapping, raising money, and investing is hopefully what I can share today. All right. So what does this mean? So how does this actually work? How does capital planning work? By the way, you're the little green thing at the top. So your company is starting, and really what this slide is trying to impart is there's an asymmetry of power. And what that means is you're the one out there begging, scratching for money, and generally this is how the investor-entrepreneur relationship works. Now, the investor isn't going to definitely flaunt that right off the bat, but in reality, if you want the investor's money, you're going to have to take the investor's terms unless you have other terms that you are willing to get into competition with, and we'll talk about that in a little bit. So what that means is you have to understand if you're taking money, especially at the super early stage, that you are up against that guy. And that guy's pretty formidable. And that guy has more information than you have around financings, because that person's done a lot of them. That person probably has better legal advice and can pay for better legal advice than you can. And so what I'm hopefully trying to do is to give you a little bit more of that power back as you start this journey. And obviously, they're not all fat guys like that, but as we start this journey to financing, I want you to understand how it works. The other concept, so there's 2 concepts I want you to dream about tonight as you go to sleep. This is one of them, kind of a fun thing to dream about. The second one's this. you only have so much of your pie. And so as a entrepreneur undertaking this voyage, you have to understand how this pie is going to get divided up over time. Now, what I like to talk about as it relates to this pie, which I think is strawberry rhubarb, but I'm not sure, is the fact that the pie is going to be different, or how you divide the pie, based on the type of company you are. And my advice on how you divide that pie up is going to be different based on your strategy and your upside. So let's take two examples just to illustrate this. If you are a lifestyle business, which is most of the companies in this room, likely from a statistical perspective, meaning you are not going to raise venture capital. Many of you might try, but you're going to fail unless you can move into a space. Sorry, that's a bit doomsday, but it's just the facts from a statistical perspective. 1 out of every 100 companies gets funded by a VC. Boris Wirtz, who many of you guys know, just put out a stat today. He meets with 25 companies a week, and he funded 10 last year. So think about those stats as it relates to your business. Unlikely you will be funded. So what does that mean? It means you're more like Iron Point. And if your pie looks like that, then you need to divide it in a certain way, right? Because your upside is likely not going to be venture type upside, i.e. 10x. It's going to be lower. And so what you want to do is you want to maximize that upside. You want to maximize the terms around that upside, and we'll talk about that. If, on the other hand, you happen to be a strange loop or a larger venture possible pie, you're going to divide your pie up differently, especially at the beginning as it relates to family, friends, angel, seed, and all the way up to venture capital. So you have to think to yourself realistically, and this is part of the New Ventures BC competition, which I think is great, is what kind of pie are you? And then you need to start dividing up things when you start to realize what pie you are. Now, many of you think you're the venture capital pie, and that's cool. There's nothing wrong with that. I applaud that. Go try. Many of you aren't. So we can talk about that as we go forward. Clear? Okay. And again, ask any questions as we go through. So let's talk about what you guys want, because you're on this teeter-totter. You're at the top, the angel or the seed money or the VCs at the bottom. You want money. Number one, first and foremost, is you likely want money. You want access to value add, but I will put that below money because most people struggle to raise any money. And you want introduction to strategic partners, strategic customers, et cetera, et cetera. What you don't want is value destruction. And when we talk about value destruction, we talk about the VC or the angel or the seed investor or the accelerator that comes in and tells you how to manage your business, that takes away from the real fundamental goals. You don't want that. So what you're trying to do, especially in early stages, is get money that is trying to help you and is pushing you in the right direction. So that's what you guys want. I'm hopefully telling you what you want, but that's what you really want. What I want on this side of the table as an investor is I want a big return on my money. And the reason I want a big return on my money is for those stats that I just articulated. So if 1 out of 100 companies are funded by a VC, 1 in 10 has a great outcome, 1 or 2 have an okay outcome, a couple of them are living dead, and most of them fail. So when I'm investing in you, whether it's GrowLab or as an angel investor, I need to see a 10x. And that's where you're going to decide what kind of pie you are, right? So if you can't return me a 10x, then you don't fit my profile. And because you don't fit my profile, I'm not going to invest in you. So it's very clear what I want. If I'm taking risk as an angel, I want 10x or more. I need a story that tells me that. Okay? What I expect from you is I want honest progress updates. I want an opportunity to help but not hinder. And I want to have some advantage for taking the big risk on you. So I don't want to be crammed down in a future round. I might want seniority in the cap table, which we're going to talk about. But the reality is I want something. Please, guys, give me something for taking this bet. Now, one thing we're going to talk about, and we can talk about right now, is there's a difference between an angel round and a family and friends round. In a family and friends round, this is the equation might be different, and it's family and friends for a reason. So mom, dad, I need 20 grand. Mom and dad probably aren't going to ask for seniority in the cap table. They're probably, from their perspective, it's a donation that if they ever get paid back, that's fantastic. That's different money that should be treated differently than a professional angel or an accelerator or going up through a seed investor. If you go to the angel group or the angel forums in town, you have seasoned angel investors. They're looking for 10x. They're going to want something in return for that. And that's fair because they took the risk on you. So I want to set up that dynamic of what you guys want and what I want. And I used to be in your shoes. So now if you look at it, one of the questions that comes up all the time that I'm going to try to answer with one big slide is, do I do debt or do I do equity? Let me just explain for those people who don't know what debt is and how I'm referring to it, because debt takes many forms. I'm talking about convertible debt. And what convertible debt is essentially a debt to the investor at a certain interest rate, which can convert to equity upon certain milestones. Generally, that milestone is another financing, and generally that debt converts at a cap and a discount to that cap. So this is where we get a little bit technical. But what it essentially means in your world is the investor doesn't want to value you because you're too early. You don't have revenue. You think you're worth more than the investor is. Why have that discussion today? And so where convertible debt has gotten a lot of traction and progress, and I love it as an instrument, just to be clear, is it takes the valuation question away. Now, you've capped your valuation for that debt, but you haven't capped it for your next round. Meaning, you could have a $20 million next round, but this particular debt converts it 3.5 at a 15% discount, as an example. So you've certainly capped your upside on that debt. What's nice about it is your legal costs around most matters are basically zero. You might have a lawyer look at the convertible debt document. There's lots of them out there. The one that we prefer is the Business Development Bank of Canada's convertible debt, which I think is actually public, and if it's not, I can send it to you. Founder-friendly, very clean terms. And so if I'm an entrepreneur today, I wouldn't spend time pricing my round. I would go with convertible debt because it's fast, it's cost-effective, you move the valuation question out, and most importantly, potentially, for many of you, you still have control. You don't have someone on the board. You don't have all the rights that go along with that. And so you get something for giving something up. I'm going to stop there. Any questions about convertible debt? Yes. Oh, here comes a mic.
Well, since it's called debt, obviously what happens if you cannot pay it back? And would an investor take away your company or your assets?
Sure. The convertible debt can be secured, would be secured in terms of senior debt in the company, i.e., if you can't repay the debt, the company goes to that investor. It also, and I've seen this a couple times, can be secured personally. My advice to all of you is don't secure it personally. It's too risky. But if the company is securing it, that's a reasonable bet. In other words, it's unreasonable for you to say to your debtor, the company's not responsible for it. It should be the most senior debt in the company until other debt is taken on. And if you can't pay it back, the person who gave you that money has the ability to call the debt and put you into bankruptcy. Yes. This is an important concept, actually, so let's focus on this. Yes.
What's an average interest amount as well as term? So how much is it going to cost me and how long do I have to pay it back?
Yep.
And is there any sort of grace period or et cetera?
If you take the BDC terms as an example, and don't quote me on this, what I've seen is around an 8% interest rate. I've seen up to 12 and I've seen 15. I would do somewhere in that lower range if I was an entrepreneur. Generally, it's a 2-year commitment. There's no grace period. What generally happens is the negotiation, that pull and push from the teeter-totter perspective, is as an entrepreneur, you would go to the person that you owe the debt to and say, I can't pay it back. I'm willing to extend. And generally, it's not in that person's best interest to put you out of business. In other words, the dynamics are such that generally you're going to get an extension. That person is getting interest on that money over that time period. That's fair. And so what I've seen is 2 years as a general time frame. No problem. Question?
Could you give a specific example with numbers when you lended some money and then converted this debt to equity in terms of how much equity it became and what the numbers were and what the market cap at the time of conversion was?
That is doing some gymnastics in my brain. Okay, so let's do it. Let's do a very simple example. So the question, as you guys saw, was give me some numbers on how this works. So let's take my numbers are going to be wrong because I'm doing the math in my head, but let's take a $200,000, let's actually make the math easy. Let's do a $350,000 convertible note at a $3.5 million cap. Okay? So that would be essentially 10% of the business. Now, let's assume that person gets a discount of 10%. So instead of a $3.5 million pre-money, they're getting $3,150,000. So what happens is, at that stage, they're getting more than 10%, right? So they're getting that delta of the 15%, and the numbers would be slightly more, say 12%, as an example. In other words, the pitch to you as an entrepreneur is, I'm not valuing it today, but the pitch to the investor is, if you would have valued it, you would have gotten 10, you got 12. Now, the next, let's say you raise at the same round an additional $500,000. That $500,000 converts at the whatever price you raised that round at. So let's assume you raised the round at $4 million because you had an up round. That 500 goes at 4. In other words, the debt converts and the 500 is a different equation. So does that make sense? In other words, the debt would convert at a different rate than the actual valuation. Now, one of the questions that you guys might ask, which I've seen, is, does this really put a cap on your company? And the answer is, in most cases, yes. In most cases, your next round is going to be raised at about the cap, if you're kind of making progress. I've seen people, quote unquote, bust the cap, and that's like a big hurrah, and you have wine and cheese, and that's great. Most people are going at convertible debt to cap, and then their next round goes up. In other words, normally investors, that $3.5 million is a good number in the BDC note example, because that's generally what companies are raising at that stage. If you bust the cap, kudos to you. And I've seen 3 or 4 companies actually in the last couple months bust the cap, which is awesome for those companies, and awesome for me. Any other questions about convertible debt versus equity? All right, let's keep going. So now let's talk about why share structure matters. And this is a really interesting conversation if you can find this stuff interesting, which I actually do. And it's interesting for a couple of reasons. And this comes back to what kind of planning you're doing. So if you are a lifestyle business, you do not want to go preferred shares, stay the heck away from it. That's going to hurt you, and I'll demonstrate what that looks like. If you think you're the best business ever, and you're going to go to the moon, maybe a preferred share is acceptable to you. Now, in my experience, a preferred share is not as attractive as a common share. And what you'll see in the ebb and flow of the investment world is, as entrepreneurs gain more power, meaning today, you can push for more entrepreneur-friendly terms, which would be a common share. A preferred share happens when a couple of things happen. One is, I can't agree on valuation, and I don't want to do convertible debt. And so you might want some really big valuation, but I want a preferred share. Secondly, 95% of the VCs are going to want a preferred share, and we're going to talk about what that means. And thirdly, you are trying to plan out a multi-stage raise process, and you want certain preferred shares for different stages. So there's sort of 3 reasons why you might want to do a preferred share, but my advice to you is only do a preferred share if you're going to the moon. If someone comes and you don't think you're a 10x and they don't think you're a 10x, don't do a preferred share. And the reason you don't do a preferred share is because this is going to happen. So this is a very handy tool. And what this shows you is what a preferred share does, and specifically a participating preferred share. I'm not going to get into all the details. We don't have time to do that. But essentially what that means is, if I have a preferred share, I get the first money out of the business. So what you'll see is that when the value of the exit is low, you'll see that the common shareholders, i.e. all of you founders, don't participate. So you actually have scenarios where you could have a $12 million exit and you see nothing. Now, the investor is going to come and say, I put $12 million in, I get it out. And there's a very fair argument to be made there. The challenge on this is aligning interests. And so we're going to talk about aligning interests when we get into more of the legal terms, but share structure fundamentally matters as it relates to the value of your exit. Now, as a preferred shareholder in a participating scenario, I have the choice. I can either not participate, which means I get my money out on a one-to-one basis, or I can convert and participate. And again, I'm not going to get into the details yet on that, but suffice it to say the point of this slide is value distribution to shareholders in a preferred share scenario goes out to the money first. In a common share scenario, you participate equally. Now, obviously, you would participate vis-a-vis your pro rata share of the company, i.e. how much you own, but as soon as you start playing the preferred share game, you're that little sliver on top. You're up here. And if you want to play that game, you better strap yourself in and get a big exit, or you could spend 7 years of your life getting nothing. Any questions about this? Okay. We're going to go into more detail. So now, I'm actually not that really a detail-oriented guy, but as it relates to some of these things, one of the points of this, I believe, is education. So now we're going to have a discussion around certain terms that are going to bite you in the butt as it relates to capital raising. So here we go. Common versus preferred we've talked about. As an investor at GrowLab, I participate in common shares. I do that because I want to align my interests with you. If I worked for Sequoia or Kleiner Perkins or Excel, I would participate in preferred shares. Second, liquidation preference, which we've talked about, whose money comes out first. Third, do I get my preference money back, i.e. can I double dip? Now, this has really gone away in terms of when I first started my business. I look like an old guy back in the day. In 2001, after the dot-com bubble burst, investors would come to you and say, I'll give you $1 million, but I want a 4x preferred share. And what that means is I get 4 times my money before you see a penny. I even saw 8 times in certain scenarios. That's gone away. The culture of the entrepreneur now is so strong, and there's so much money chasing so few deals that we don't see that culture anymore. But if the world starts to swing back, which it could, you're going to start to see liquidation preferences and multiples on liquidation preferences. Pro rata rights are super important as it relates to this pie. And what pro rata rights are, basically it means, I'll give you the example, I'm an investor, I own 10% of your company, and on the next round of financing, I get to participate up to my pro rata share. Seems fair, right? I'm giving you good, cold, hard cash. I'm giving it to you at the same terms as the next investor, i.e. I'm not telling you what those terms are. The problem is, imagine you're a good company. This has happened to a lot of the great companies in this town. You're a great company, and you raise at $10 million. You raised from me at 2, now you're at 10. And everyone wants to get into your deal. So what do you do as an entrepreneur? You go to guys like me, and you say, hey, I know you have a 10% pro rata, but would you mind pushing that down? And I say, no way. You're the best deal since sliced bread. I want my 10%. The reason I put money into you to begin with was so that I could ride my good deals forward. Every investor is going to have the same comment, right? So now who gets crammed down? Well, it's you. So you now have to suck up. In other words, you don't have a pro rata. And so if you think about how the financing works, you're getting all this money, but a lot of that is coming off your plate. Now, not to give you any tips to use against me eventually, but the way that you would play this with your initial investors is you'd say, I can't close the financing unless you take a haircut on your pro rata. So if you went to a good lawyer in town or you went to and had good advice, that's the stance you take. But the problem with giving up pro rata, which you have to, is you run into this scenario, which is good and bad. Does that make sense? Any questions about pro rata? I think that's an important element of this pie business. One other comment on it, there is something called a super pro rata. And a super pro rata makes it so that I can get even more of my share. I love you, I want to get into your deal, I'll give you a good valuation if you give me a super pro rata. I wouldn't do that. Information rights. What type of information rights are you giving away in your business? Are you giving away monthly, quarterly, yearly? Don't make this too onerous on yourself. If you have someone that comes and asks you for monthly audited financials or something crazy, please don't take their money. That's just craziness, especially in the early stage. My perspective on this is you should be giving yearly notice to reader or financials. I don't think an audit is necessarily at the early stage. If someone's asking you to do that, it's 15 to 20 grand that you should be spending on product development or something else. So when investors start asking for that, I would start thinking about red flags. Other, drag along. Can you force others to sell your company? This is a really important clause, and it's important for you as an entrepreneur, especially as it relates to that stacking of preferred shares, because you might still own 70% of your business. Along comes an early acquirer, and you want to sell because it's awesome for you. You just made $3 million, as an example. You can't have an early investor come in and say, sorry, you're not selling. Now, we'll see in the next slide who asks what as it relates to these issues, but drag along early in the process, especially if you don't hold a super majority, i.e. 75% or 66 or however your shareholder agreement or articles are written, you want to have the ability to force someone else to have an early exit because that's just good for you. Two more, co-sale, right of first refusal. Can that person sell their shares to others? Or if you're trying to sell, can they buy your shares first? So those are two rights that you're going to see in the next slide, who gets what. And then protective provisions are the most kind of interesting clauses here, because I could own 5% of your business, and I've seen this many times. I can own 5% of your business, I gave you $10,000, and I want you to write up protective provisions that you can't spend more than $3,000 without my approval. You can't hire and fire without my approval. You can't ever get a salary above $2,000 a month without my approval. So there are ways to control your business that are outside any of these clauses. In other words, I might own 1% and I can control 17 different strategic decisions that are going to handicap you as a business. Common ones around protective provisions are things like you can't do a merger without a certain approval. You can't spend $100,000, or in some cases less, depending on how much money you raise, without the approval of shareholders. You can't go and sell yourself without a supermajority. Those are reasonable. You don't want some person who owns 2% of your business blocking those decisions. So now let's look and see who wants what. So I did this sort of angels versus venture capitalists, so you can sort of plan this out as you go. Angels generally okay with common shares. Some angels want liquidation preferences. We're going to go through the angels first. Some even want participating rights. All of those angels, unless they're God's gift to angelhood, are angels you should think twice about in terms of whether you want that money now. You might need it. In other words, the money drives the deal, like we said earlier. You might need the money. That's fair. Think hard about that money before you take it. Pro rata rights. Well, this comes back to the discussion about I put money in you earlier. Shouldn't I get something? And pro rata rights is what you should give. That's reasonable. Understanding what might happen later in a good scenario. Board rights. This is something that's hotly debated. Do I get a seat on the board when I'm your first angel money in? My advice on that is if you've known the person for a long time, reasonable. If they offer credibility to your board, reasonable. If you just met them at an angel forum or through a connection, don't do it. You don't want someone on your board that you haven't dated hard for a while. So don't make that call. This is like any marriage. Don't go to Vegas and get married at the church there. Yes, question.
What is involved with board rights? Like, what does that mean? They have a seat on your board. What power does that give them?
Yeah.
What does that mean?
Great question. So let's build a pyramid of decision making. The first pyramid is when you guys all incorporated your business. When you incorporated your business, you either did so provincially or federally, and that gave you articles of incorporation. So imagine those articles are what guide the base of your pyramid for every company in this room, okay? On top of your articles, you stacked a shareholders agreement. How many of you guys have a shareholders agreement? Put your hand up. Great. And what a shareholders agreement says is my company's different than every other company, and trust me, I've had a shareholders agreement in all my businesses, and I want to govern these 12 issues that supersede my articles. So as an example, articles don't speak of death of a shareholder. What if you guys are in business together and you die? So I have this all the time. I'm in business with my twin brother, my identical twin brother. He looks like me, talks like me. He's 2 minutes younger. He's not as good looking, Joshua. And he's smarter than I am. I just pointed at the camera because he might be listening. So when I got into business with Josh, I didn't get into business with Jill, his wife, right? I love Jill. She's awesome. She's not my business partner. So when let's use the more morbid experience of me dying, Josh didn't get into business with Shannon, my wife. So when I die, in terms of how in terms of my personal will and testament, my assets would go to Shannon, right? So Shannon's now on the board. Shannon's now deciding these things with Josh, and that wasn't our agreement. I didn't get into business with Jill. Josh didn't get into business with Shannon. So what a shareholders agreement will do is it will speak to some of those issues which are not spoken to in the articles, and it will define how those things are handled. For example, death of a shareholder, I believe, should be handled with a crystallization of the value of the company upon the death, but you shouldn't hinder the company from a payout perspective for a reasonable period of time. In other words, if I crystallize the value, it's $1 million, well, the company and other shareholders are now on the hook for $1 million, could bankrupt the company. What's reasonable? 24 months, 36 months. I want to do the right thing for my brother's estate or my business partner's estate. I don't want to cripple my business, and I didn't get into business with my brother's wife. That could get confusing. Does that make sense? There are other provisions that the shareholders agreement will also dictate above and beyond the articles. Common ones are drag-along provisions. Common ones are buy-sell provisions, i.e. shotgun, which is my favorite clause of all time. Things like what happens when someone wants to transfer shares. Things like what happens when I go bankrupt or I go to jail for murder. Well, you don't want your business partner to be that murderer in jail. What happens? So shareholders agreement sits on top of articles. In the shareholders agreement and in the articles is a provision on how your board of directors works. Most people will put that in the shareholders agreement and be very specific about that. And the board is responsible for certain decisions under certain circumstances and is elected under certain conditions and under certain circumstances. So the way I see it is the board sits on top of the pyramid, but the board is dictated by the shareholders. Now, in certain cases, you can enshrine rights in your board that are above the shareholders, but if the shareholders can vote the board in and out, they can essentially replace the board at any time. So in an early stage company like you guys are at, it's like you are the king. You are the shareholder, you are the board, it doesn't matter. As you get larger, you are going to start to lose control of your board. And what that means is, in a typical venture-funded company, they're going to have the CEO, usually a co-founder on the board. They're going to have two money, VC1 and VC2, and they'll have 2 independents. Okay? So imagine that scenario. You got 5 people on your board, and those 5 people decide to fire you as the CEO. Right? You're doing a crappy job. You're fired. What happens if you own 70% of the business? Right? So is that fair? What do you do in that case? And so what the board does is it has these macro decisions, but it's governed down that pyramid of value, to the shag, to the articles. So the board is an incredibly important part of the business, especially as all you guys lose control. Because at a certain point in your financing, you lost control. You don't have 50% of the shares, and you certainly aren't controlling the board. And now the board essentially, it can do what it wants as long as it gets certain shareholders' approval. So the way I think about it is a pyramid. Does that make sense? Okay. Any other questions on that? Yeah, go for it. I like it.
Does the board help you?
Does the board help is the question. I have seen boards that are, so my boards have been incredibly helpful. I've seen unbelievable wealth destruction happen at boards. So, and that's why I talked about the Vegas dating example. That's a big decision, and I've seen terrible boards act not in the best interest of the business, maybe in the best interest of an investor or a personality or an ego. And I've also seen boards that are absolutely working in the best interest of the business, and that will always be in the eye of the beholder. In other words, if you're the crappy CEO that gets fired, you're not going to like your board. And so your determination would be the board sucks and the board, did this, and the reality is you might have been doing a crappy job. So power dynamics are really important, and as you're building this pie out and building out the value in your business, you need to be very conscious of those things. No problem. Any other questions as it relates to that?
Sorry for the question.
Yes.
So is it prudent to say, because I've heard get a board in place as soon as possible, whereas I'm a little bit more cautious and want to take my time in finding the right board members, which means not rushing.
Right.
So which would be the better? Because I've heard get that board in place as soon as possible.
Yeah, so the one thing I'm going to say about every single thing that I should have said this. This is my caveat I usually put up for at the start. This is like my disclosure on like radio ads when you talk really quickly, like Angie did at the start. That was great. Is the fact that everyone's going to give you different advice. Mentor whiplash. This guy says this. This guy said this. This guy said this. I can only speak to my experience, and my advice is build your board slowly. And the reason I say that is because of that sort of proposition, that value board, shareholders, articles, you're making significant decisions, and those sometimes are, you can't go back from there. So when an investor says, especially in the earliest stages, this is a red flag for me, and this is my advice, just to be clear. When an investor says, you need to professionalize your board, and you have no customers, your product's not ready for 2 quarters, you have to look at that investor, and you might not say this because you want to be respectful, but you want to have this conversation with your co-founders and say, why are they worried about my board? I don't have a company until I get my product out, until I get sales. So when that kind of conversation starts to happen, you need to start questioning whether your perspective on business is the same as that person's perspective on business. And my perspective on business, which is neither right nor wrong, but is my perspective, is that person I don't want as an investor. That's my perspective. Any other questions on this? All right. So we're going to come full circle. So we talked a little bit, and then I want to open it up to questions. We talked a little bit about what that pie needs to look like. I think the big message tonight that I wanted to discuss was the fact that your decision-making sort of starts at a tree. What kind of company are you? If you decide you're the type of company that could raise capital, then you have to start deciding on these terms that we discussed a little bit. And I didn't get into detail because there's 50,000 terms, and this is not going to try to be focused on educating you on each of them. I tried to highlight the ones that I thought were important. My advice to all of you is the market will dictate that. That guy or gal at the bottom of that from a money perspective is going to dictate these terms unless you guys do something about it, which is you kick ass and take names on traction. You have multiple term sheets at the table, which is going to drive competition, which I'm sure there's another session on and how you manage those things. And the reality is if you don't have those things, the money's going to dictate the terms. And so everyone talks about how, a typical investor reaction, interaction, it happens to me all the time, is, hey, I'm Acme Company B, I'm raising money at a $4 million valuation. Well, no, you're not. That's what you think you're going to raise money at. That's what you're negotiating to raise money at, but that's not what I'm going to put money at, right? And so when you start going out to the market and start, and your mentors will work with you on how much money are you looking to raise, what are you going to use it for, I think it's a big mistake, and this is, again, a personal opinion, to put your valuation in. Your valuation is not something you decide arbitrarily. You might put in logic as to why you think it should be valued in a certain range, but as soon as you start putting valuation on the table, what I say back to you very quickly is, who's your lead? Where did the valuation come from? Where's the term sheet that says that you're worth $4 million? Because what you say, with all due respect, isn't as relevant as what another investor is going to say. So I'm going to leave you with that. I want to see if there's any questions. I know that we have some more sessions on other types of financing. And the last thing I'm going to say on those types of financing is non-dilutive financing rocks your world. New Ventures BC financing, IRAP financing, NSERC financing. Canada is a beautiful place to hack together enough money to get something to the market. And as companies, their amount of money that they needed to raise has gone down. You can put your company together for very little equity financing. And this goes against what I do for a living today. But man, oh man, take advantage of that. It is a beautiful thing. So I'm going to leave you with that. Yes, question.
It's probably a little bit outside of the context, but since you're from GrowLab, and usually you guys evaluate companies at 5, so you take 5 to 9% for 30K, right?
That's about right. Yep.
So that means that, is this a fixed evaluation, or is it also up for negotiations?
So you're asking me to negotiate on a live internet camera. So I generally don't negotiate against myself. And so what we're looking for is great entrepreneurs. So I'm going to totally dodge your question like a politician would and say, we are looking for great entrepreneurs. I'm going to flip the power dynamics and say I have 400 applications for 4 spots, and we try to get the best entrepreneurs. That's my answer.
So my question is actually related to that, to looking for great entrepreneurs.
Yeah.
Here's an example. I have a startup. I came to you and I raised some money. Eventually, I got into those 70% of startups that fail. And a few years later, I started another company. And I come to investors again, trying to raise money.
Yep.
So my question is it easier or more difficult in this case for me to raise money? And what I'm referring to, as you said, you're looking for great entrepreneurs. And my assumption is that if someone already believed in me, then it is easier to get money the next time. On the other side, if I already had a chance and I had some money and I failed, this is some indication. So
total personal opinion on this answer, but it's very simple for me. If you failed, I want to talk to you. So it's very simple. So I love failure's great. And people who failed learned the hard way. I wouldn't say just because someone believed in you to begin with that makes any impact on my decision. And what's so interesting about investment decisions now versus even when I started Strange Loop is I don't believe your story. Meaning your story is total semi-irrelevant to me. And that's kind of crazy. I want traction. Show me traction. Traction is the new IP. I say this all the time. Your story is irrelevant. Your background's relevant as it relates to your company and your traction, but you don't come and raise money on an idea anymore. It doesn't work that way. You need to show me traction. So if you're a smart entrepreneur and you're a multi-time entrepreneur, you're going to understand that. You're going to come to me with traction, and that's the sexiest thing ever. Traction is the only thing that's really sexy to me now. I'm a married man, but traction is ridiculously sexy. It trumps everything. So I'm taking your answer and skewing it back to traction, but I love multi-time entrepreneurs because you've been there and done that. You've made mistakes, you've learned. That's a huge bonus for me. I don't care whether you failed or succeeded. You've done it before, that's good. Now, you might be jaded. That's fine. We'll get over that. But I love it. Great. We should talk. Yes?
Should you ask for more money than you think you need?
Oh, absolutely, yes. You should always get as much money as you can, especially at the stages. So people would disagree. So people always talk about valuation milestones, and I talked about traction just a second ago. If you have no traction, you want to get as little money as possible to hit a traction milestone. Then you start to raise, and the reality is you always need more than you think you do. And secondly, money begets money. So one of the things I always say is every round you ever close should be oversubscribed. And this is kind of the dirty little secret. So as an example, you never announce the size of your round until you have it mostly wrapped up. And I see you guys do this all the time. So you're around, how much are you looking to raise? 400,000. How much have you raised? 10,000. Oh, man. So now what I'm going to do as an investor, the signaling you just gave me, is I'm just going to wait. I want to put 50 grand into you. I'll put it in when you hit 350. Don't make that mistake. And so what most people will say, especially in this town, is no one's willing to lead my deal. No one's willing to lead my deal. Well, that's because the dynamics you just set up aren't in your favor. You're pleading for someone to lead the deal. I'm not going to lead your deal. I want Boris Wirtz to lead your deal. I want Mike Edwards or someone from the Angel Forum. I'm not doing it. And so what's in it for me is kind of the question. And so yes, you want to raise more money, and the way you refer to your raise is really, really important because many people are dead before they even start. Any other questions? Yes, in the back.
Yes. It sounds like you're speaking about performance. So when you're asking about raising an amount of money, is it prudent to ask about stages, like I want to raise this amount and then I want to do this amount, even though it may not be exact, just like kind of like an estimate, but not really evaluation, just like a goal milestone?
So let me try to clarify the question. Are you suggesting that you want to raise in tranches, i.e., I want $2 million from you, but I want you in these tranches? Or
No.
Okay, so explain again.
What I mean is, let's say the first time I want to go for a raise is like, let's say 50 grand, 100 grand.
Yep.
Then 250 grand the next round.
Right.
Then 3 to 4 million, and then maybe if
Sure.
things go well, 25 and up.
Yep. So my philosophy on future business planning is I don't believe you, and you're pulling your numbers, can I swear, out of your ass. And so that doesn't mean anything to me. And so what that means is if you think you're going to raise $12 million in 2017 and go to these 6 trade shows, you spent a lot of time wasting your time, and I don't want to invest in you. So how far in the future can you look? My perspective is the next milestone with a vision beyond it. I wouldn't plan out your next 6 raises because it's not going to happen that way.
Yeah, and I'm not saying those are plans. Those are just ideas. Like, let's see if we can get to stage 1.
Stage 1 is all you can think about, and if you hit stage 1, you beget stage 2. And I wouldn't think more than that. Now, one thing I'm going to bring up, actually, which is you just brought to my mind, which is really important, is if I'm going to raise money, part of this equation, this is a terrible analogy, but how big is this guy or gal? Meaning, how much money do they have? Because one of the signaling factors that I find entrepreneurs get into is they go to someone who has $20,000 to give them, right? That's a difficult signaling because when you go back for the next round, you need those people to participate. So you just brought up a really good point, which is you need follow-on capabilities in your investors, especially at that early stage. You can't go and get a completely new set of investors on your second seed round. Because the question for me from an optics perspective is, why aren't these 7 people participating? What do they know that I don't? So one of the questions I always ask, and you should ask, is what's your follow-on capability like? If I do what I say I'm going to do, and you put 15 in now, could you put 30 in? Can you reserve? And most angels and entrepreneurs angels and VCs will do that as a matter of course. I would be explicit about it. You need to put more money in the next time if I do what I'm going to say I'm going to do. Yes, in front. Angie, you're quick.
I've had 2 people in the US who want to help me find investment from the US market, but they've also asked for finder's fees. Can you talk about that?
The world of finder's fees. There are finder's fees in places that are... So here's my take on it. If you're not the entrepreneur selling me, I'm not going to invest in you. So many VCs, so this depends on your stage. At the earliest stage, my advice is you stay away. At a later stage, when you have real traction that can be communicated on a piece of paper that says, my revenue's 10 million, my EBITDA is this, then it becomes more of a financial transaction. That's different. Because now I value you on financial metrics. Having competition in that financial metrics makes a lot of sense. And so is it a good use of your time to get all that competition together? No. In that case, it makes sense. At the earliest stage, it does not make sense. It might make sense to compensate someone with with shares, with options, cash, I wouldn't go into, especially a chunk of the cash you raise. Because that's just going to bring up a whole issue with the investor, which is I'm not putting money into the company, I'm putting money into this semi-rich person's pocket. That doesn't make any sense. On the flip side, for M&A, if you're going to get acquired, I believe, my last transaction, I had a banker. Bankers offer a lot of value. So early stage finance, I don't like finder fee, I don't like that deal. Later stage finance, you've got 10 million plus in revenue. It makes sense. They might make their fee just by bringing more competition to the table. In M&A, I think it makes a lot of sense. That's my answer. Question?
How long should you plan to spend all the money? Like, should you prove to them that you're going to spend the money in 6 months or in a month? Or can it be a 2-year plan? Or
I kind of like 18 months, if I was just going to answer off the cuff. I like an 18-month plan. I think an 18-month plan gives you enough room to hit or miss a little bit. Anything shorter than that, I think, is too narrow, and you're going to spend, imagine, for most of you guys, you're going to spend 3 to 5 to 6 months, especially if it's your first time raising this money. You don't want to do that, and you have to do it in advance of the date. So if you do a raise now for 18 months, in 12 months, you're pounding the pavement again to do it. And so I wouldn't want to do it any earlier. My philosophy in general has always been to raise a lot of money, as you can see from my history in my last business, and that gives you more ability to execute. Not all of you are going to be that lucky, but I would argue 18 months to 24 months is a good chunk of time. I like that number.
And what if you're wildly successful, more than you thought you were in your plan?
So great.
And you're making so much money that you don't need to spend all of that money.
Could you imagine that problem?
I know, right? But has there ever been a point where somebody paid the money back? Because I've heard that happen with certain companies.
So Dropbox, don't quote me on the numbers, had I think $100 million in the bank, and they just raised another 100. So it's your question's twofold. One is, has it ever happened? The answer is yes. Has anyone ever paid the money back? Very unlikely. And the reason is the investor doesn't want it back.
Right.
I want your money in your business working for me, please. There's no provisions for me to get my money back when a business is doing well. It's the exact opposite. What happens in those cases is I'm the guy who wants to put more money into immediately. And that would be a wicked problem to have for most companies. Yeah. Yeah. We can't plan for that one.
When you talk about traction,
yes.
And I know it's a very general question, but
Yep.
What sort of traction? What are you looking for?
So I divide it into two sides, consumer and enterprise business, so B2C, B2B. In B2B, which is mostly my experience, I need referenceable customers who love your product. Simple. And if those referenceable customers are big and have a logo I recognize, even better. eBay's using it, Walmart's using it, Amazon, that would be the pinnacle. But even locally, London Drugs loves it, IGA loves it, the guys down at, whatever it is, love it. So, and the reason I want that is for social proof. I want to call up the guys at IGA that I know, or Walmart that I know, and say, what do you think of this guy's product? So that's number one. On the B2C side, two factors I'm seeing more and more, and I'm learning this side because my background as an enterprise guy, is number of users and growth, and specifically week over week or month over month growth. So I want to see a trend line. We like to call it 10% a week at GrowLab. So one of our companies right now, Spark CRM, shout out to them, are doing 12% a week week to week growth. If you put that growth on a chart, that is really impressive. I want to see 10%. Some people now talk about the 1% a day. I just invested in a company at 1% a day. That's cool too. I'll take 10% a week. Maybe one equals the other. I don't know. I think 1% a day is better. That's the type of metric I want to see. In other words, what I don't want to see is some person comes to me and says, I have 10,000 users. You're like, that's amazing. Not really, but great. How many did you have last month? 9,500. How many did you have the month before? 8,000. Like, I don't want to see, lumpiness is okay. I want to see real significant growth. And so what I see a lot of people do is they say, we threw all this money into marketing, we got 8,000 users. And 7 months later, I have 7,800. I don't care. That's not traction. And so for me, it's growth and it's bulk. And it depends on the business. Growth by far and away is the sexiest one. Every week, every day I'm growing. Any other questions? I think we're almost at time, actually.
For a perfect time.
Perfect. All right. Well, thanks, everyone. I'll be around if you have any questions. Thank you.
Okay, so my name is Megan Griffith. I work for the Pacific Regional Office based here in Vancouver. And I'm going to talk to you today about the NSERC piece of the pie for early stage companies. I'm going to start off by giving you just a very high-level description of NSERC and then talk about specific funding opportunities for you. Okay, so how many, just by show of hands, have heard of NSERC? Oh, that's more than I thought, but it's still only about a quarter. So NSERC is the Natural Sciences and Engineering Research Council, along with SERC, who supports social sciences and humanities, and CIHR, who supports health research. We round out the federal tri-councils. NSERC's annual budget runs about $1.1 billion, so significant. And we invest in almost equal three parts. Areas that we refer to as people, which means scholarships to students and fellows, so to provide training for next generation scientists and engineers. Discovery, which refers to the support of basic science happening in a university campus. So typical professor's lab would be often supported by a Discovery grant. And then finally, the Innovation Suite, which is the area that I work in, and that refers to research partnerships. So collaborations between companies like yourselves and an academic. So we divide it roughly into 5 streams with multiple grant opportunities in each stream. Way too many to talk about today, and many of which you wouldn't be eligible or the opportunities wouldn't be meaningful to you at this point. But just to illustrate that no matter where you are in terms of technological maturity or the size or scope of your project, there's likely an opportunity suitable to you when you get there. Okay? So how does it all work? Well, basically, a company and an academic put forth an application to NSERC, and then NSERC supports the cost of the research. Sometimes the company is required to contribute cash as well, but NSERC always carries some of the costs. Okay, and in British Columbia, you've got 10 NSERC-eligible universities to choose from and 11 colleges. Again, by show of hands, is there anybody who's here from outside of the Lower Mainland? No, okay, so everybody's local, but there are post-secondary institutions throughout the province and one in the Yukon to work with. So, first opportunity you might be interested in. I see many companies hire co-ops, and particularly at an early stage, it's a good opportunity. And NSERC offers one program called the Industrial Undergraduate Student Research Award. It's a mouthful that we refer to as IUSRA for short, whereby NSERC will provide the company with $4,500 to help support the cost of hiring an undergraduate student for a 16-week work term. So it meshes very well with the co-op work term, although students aren't required to be co-op, and they can be university or college students. There are no deadlines for the application, and the processing is pretty quick. It takes about a week, okay? And probably now when you're 1 and 2 person companies, you wouldn't be able to host the max, which is 15, but for larger companies, we allow them to host up to 15 students per year. Okay, and these are some past New Ventures BC competition participants who participated in the IUSRA program, so you might recognize some of the names. Saltworks won, I think, in 2008, somewhere around there. Semios Bio has been in the media a lot lately because they're gaining a lot of international clients. They're a pheromone, pest and crop management company. Hire the World, I think most people are familiar with. But anyway, folks who were in this competition just like you in past years. And here's some quick feedback from companies. Almost unanimously, they consider the project a success. Lots of positive gains by participating in the program and hosting the students. And the last point is actually the most interesting to me. A little over a third of the companies have hired at least one former awardee. So it's often used as either a scouting or a recruiting opportunity for future employees. Okay, so changing gears a little bit. Maybe it's not human resources that you're actually after. Maybe you have a particular research challenge or some big, hairy problem that you're looking to solve. So you could participate in an Engage grant or an Applied Research and Development grant. Essentially, they're the same, just that via Engage, you'd be working with a university researcher, and through the ARD, you'd be working with a college, okay? But the criteria are the same. It must be a new collaboration, so you cannot have worked with the researcher in the past. It's a very focused, industrial-driven 6-month project, and NSERC will provide up to $25,000 to support the direct costs of research. And the companies are not required to contribute cash, although you must contribute in kind. Okay? Because it's industrially driven, the company owns the IP. There are no application deadlines for this, and we evaluate the Engage applications locally throughout the regional office network, so the turnaround is very quick, about 4 weeks from time of application till you would receive a decision. The ARD is administered through our headquarters in Ottawa, but still the turnaround remains quite quick. Okay, so here's a list of the top 20 universities using Engage. UBC is in the lead nationally, which you wouldn't necessarily expect. But you'll also notice that SFU and UVic are amongst the top 20. So British Columbia and universities are very active in the program and keen to collaborate with companies. Here's an example of a local Engage project, and Meta Optima was a participant in last year's New Ventures BC competition, and they collaborated with Dr. Chow, who is a faculty member in the Department of Mechanical Engineering at UBC, to work on a low-cost imaging device for skin cancer detection. And here is Dr. Jennifer Love, also from UBC, but this time a member of the Department of Chemistry, who worked with Polymer Research Technologies, who won the competition maybe 2009. They have a proprietary technology to recycle polyurethane, largely from mattresses. And so Dr. Love worked with them on a project there. Okay. And again, here's some company feedback. This is immediately at the end of the project. So 94% report that the projects were a success. Largely the problems are either completely or at least partially solved. Lots of gains in terms of technology, knowledge, stimulus for future R&D, and so on. And almost unanimously, users would recommend Engage to another company. We checked back a little further down the road just to see if the impact is still there. And 1 year later, companies still report they are still seeing gains. And 70% state that they will collaborate further. So it's a positive experience by most accounts. And that's it for me. I think are we going to save questions for the end or for the panel discussion in the name of time?
Save them, I think.
Yeah, so thanks.
Okay, so next up is Simon Backer from NRC-IRAP. And they're going to do a very elegant mic switch while I elegantly put his presentation up. Here we go.
Hello, I'm Simon Backer from NRC-IRAP, and give you a quick overview here. The mute. Right. Any better? Good. So, what is IRAP? It's not this, right? No. It's another part of NRC, which is National Research Council. So we're another piece that sits beside NSERC, and it's the Industrial Research Assistance Program. And IRAP has a mandate from the government to stimulate wealth creation for Canada through technological innovation. So this is actually, I've been working at IRAP since the start of this year as an ITA, which is an industrial technology advisor. And I have to say I do like this mandate from 2 points of view. One, it's really great that IRAP is there helping companies do technological innovation. And also, as a taxpayer, I kind of like this mandate because it really does feel like a good thing for the government to be doing. So what is it that we actually do? We help firms go about developing innovative technologies. And when we say innovative, there's often quite a bit of risk involved, to the point that we will invest in a firm, and it's, as Jonathan said, it's non-dilutive investment. In other words, you get money from us for nothing, but it's to help take on a project to develop some innovative technology. But we really like technologies, not just technology for technology's sake, but something that can be incorporated into a product or a service, an innovative service, and then something that can be commercialized very broadly, ideally globally. We want to help companies grow and help companies get to a point where their products are sold around the world. So how do we do that? There's basically three main ways. One is giving advice. And a lot of people, when you show up at a company and say, "Hi, I'm from the government, here's some advice," that can not always go over too well. But there are actually about well over 200 ITAs across the country. We all specialize in certain sectors. We've come from backgrounds where we've either led development teams ourselves, or we've run businesses as entrepreneurs. So great depth of domain expertise and business operation expertise. So even if you have an issue and I can't answer it directly, very good chance one of my colleagues can, and we can tap into that network. The second way is by connections. So quite often we see companies, especially early on, trying to take on the entire world themselves. And we can say, look, rather than reinvent the wheel, why don't you hook up with this other company over here, or at least talk to them and find out if there's a better way to get things done. And then the third way we help, and I always preface this, and sometimes funding, because not everyone that we talk to will get funding, but sometimes we can provide funding. So what does that funding look like? There was a Royal Commission struck, and they came up with the name IRAP project. Actually, that was another joke, just not a funny one. So the first type of funding is project-based, and what we mean by an IRAP project is a project that's been put together to take on some core research and development or some technology development. The second type is called an accelerated review project, or an ARP, and these tend to be smaller projects, and they can be around they could be a technology development, but they could also be a market assessment. So say you're trying to get into something, but you're not quite sure how big is the market for your products. Or it could be a technology validation. So maybe you've got your product completed, but you're still out there with your early stage beta customers maybe, and you need to collect additional information around the ROI and validation of the product. Third type of funding that we do is the Youth Employment Program. This is a great program. And money comes from Ottawa, and it gets filters down to the regions, and we can help you make a hire of a youth. And youth is fairly broadly defined. It's anyone under the age of 30 who's completed post-secondary education. And the primary intent of the Youth Employment Program is to help people who have completed university or college get their first job in industry. and of course to help your company in the process. And then lastly, I'll mention there's a new program called the Business Innovation Access Program. And this is a program that has been designed to help companies that have a specific problem that could be solved by an academic institution or a not-for-profit institution. So BIAP, as the program's called, can help provide some funds so that you can go off and contract with one of these not-for-profit organizations to get your particular problem overcome. So if we look at the size of these programs, you can see that they are quite different. The basic IRAP project can run anywhere from $50K to $500,000. The ARP programs are generally under $50,000. The youth is up to $17,000, and the BIAP can be up to $50,000. And what does that mean when I throw these numbers up there? How do we get money into companies? So what we look at is a contribution. And again, just to reemphasize, that's non-dilutive. So we provide this money, and the way we figure out how much money you need, it's calculated as a percentage of the, in the case of the IRAP and ARP projects, it's a percentage of the base salaries, up to 80% of the base salary of the people working in the company, and up to 50% if you're using contractors. Now, I should also point out, in general, we don't fund work done by the founders of the company or the people that have very significant shareholdings in the company. The youth employment program, that money is flowed into the company over a period. It's your choice, up to 6 months or up to 12 months. And then the BIAP actually funds up to 75% of the contractor fees. Now, you'll notice with all of this that we're putting some money in. It still requires the firm to put some money in. So we don't sort of carte blanche cover everything. We're looking for the companies to have some skin in the game as well. I'll very quickly talk about the process, how we work through first finding out if you're eligible. So it has to be a Canadian operation, which everyone who's here and watching this will qualify. Under 500 employees, hands up anyone who's got more than 500 employees? Oh, none. Okay, good. So that's all good. And you have to be incorporated. Secondly, we meet with you, and generally we get to meet people at events like this and various other ways. And upon your request, really, we would come have a meeting, usually at your site, or you can come to our offices for a meeting. And the whole point about that is getting to know what your company is all about, what you're trying to do. We'll talk some more, see if we can get a project defined, and figure out, does it meet the criteria we have laid out for the projects. And at a certain point, if we say, yeah, this is looking good, we'll invite you to make a proposal. We'll give you a template to follow. So it's very lightweight, but it's really collecting information about your company so that we understand what we would be getting involved with, what you're trying to do, etc., and how much money you think you'll need. We then will evaluate the proposal. Quite often at that time, we'll be contacting firms and asking for clarifications and additional information. And then there's an approval stage, and it's a very mystical process shrouded in secrecy. But I have been doing this a few months. I managed to sneak a photo of it from. Then after the approval, this is a great part for your company, we'll start funding the project. And it's important to realize that different than an angel or a VC. We don't show up with a checkbook and say, here's a check for the whole amount, good luck. We actually wait to the end of each month. You send a claim in to us, all done online using our, we have a system called Sonar. You submit claims to us monthly, also a monthly report saying what you've done. And then money will show up almost by magic in your bank account. The terms of all of that are set out in something called a contribution agreement, which is a contract between yourselves and us, and it lays out in detail exactly how that works. And then finally, there's a report where we look to track what are those benefits to Canada. So, for example, have you been able to create some IP? Have you been able to sell the product and get some revenues? Have you hired some people, expanded R&D, and so on? So that's a very quick overview of IRAP. It's a fantastic and very flexible program. If you want to get money from IRAP, which a lot of people do, it does require time. We like to know who we're dealing with, and the only way you can do that is by having ongoing interactions with an ITA. It requires some timing. The money comes on a budget cycle that's dictated by federal budget. And lastly, it does require luck, but luck in the sense of preparation meets opportunity. So in other words, if you've got a well laid out plan and can explain it, at the same time we have budget available, your odds of getting funded increase very dramatically. So that's it. First step would be contact an ITA, and the information's there. Thank you. Oh. We'll do questions next. Okay.
Thank you very much, Simon. So, final speaker before we go into more interactive is Thealzel from Angel Investor. I think eFund is one of the main funds she runs, so she's going to talk about raising money from an angel perspective. And then after that, we'll start with a couple companies volunteered last week to be real live examples in terms of what do I do for financing. So Drive will be first, and then if we've got time, Cool Projects.
All right. Hi, everybody. It's just a test to make sure that I've got the microphone on. I'm Thealzel from the Entrepreneurs Fund, eFund for short. So I'm going to tell you about how to connect with angel investors. eFund is an angel investment fund. So first order of business is, where's the money? Because you're looking at me, I'm an angel investor, and I run a fund. So where is it? There it is. Okay, money comes is more easily than you think when there's a perfect match. And that's the key. Everything has to fit together. So you have to understand where you are in the ecosystem. Where are you on that food chain? And once you figure that out, it becomes a lot easier about how to target your company to the right type of investor. So understand what your corporate stage is. And Jonathan was talking about, M&A and venture capital. That's really near the later stage of the company. If you're an idea stage, then you're at the other end, and getting money is less stringent, because what's being funded at the very beginning stages, you're trying to turn your idea into an actual product or a service, and then you're trying to work out a business model. This is the traction that Jonathan was talking about. You're trying to figure out who will actually buy your product or service. And then you're looking to see if you can get that sweet spot of the product market fit. And then can you do it again? Because if you can't do it again, then you have to go back and reiterate your product market fit. Then once you've got this repeatable business model, could be replicated over and over again, then it's time to look for some serious money when you're looking for venture capital to scale. And then once you're having several tens of millions in revenues and years of EBITDA, you're looking to get more funding for market dominance. So who's funding? So at the very early stages, it's your own resources. And I think most of you in this room are at this stage right now where you got some money out of your own credit cards, thank goodness for Visa and MasterCard, and your Aunt Doreen. When you hit at the end, this is where you get the institutional funds. This is where you can actually go to the Royal Bank and get a working capital loan. That's your debt. You can get mergers and acquisitions money. Private equity will pour money into you because they're looking to help you to gain world domination. So angels fit right in between, right where there's a product market fit and a repeatable business model. This is really important where everything fits. So if you go right away to a venture capitalist when you're still trying to figure out what your business model is, of course the venture capitalist is going to turn you down. It's not their job. Nor is it the bank's job to fund your idea to turn it into a product. Not their job. So it's not them, it's you. So are you angel ready? This is a little graphic that I like to use to the companies to see whether they are angel ready. We're looking for that perfect product market fit. All right, you got the Facebook app that's going after tween girls because they're really great believers. You have a strategy to be able to drive the sales. And strategy is nothing without the operational framework. And if everything is working well, you're making a lot of sales of those Facebook apps to tween girls who are believers. But then the market changes. Justin Bieber's out. Someone else is in. You change that product market fit. This is the iteration. Do you have the right strategy to keep driving those sales, keep getting that traction? Do you have the operational infrastructure within your company to keep driving those sales? This is traction. This is really important. And that's what angels are looking for. They're looking to see if you got that product market fit. They're also looking to see whether you have that potential to get the next stage funding. You have your business model. You prove your traction. Angels will come in. Angels will come in to help you with your repeatable business model, because they're preparing you, if you are that type of company, to get the institutional funding to scale your business. So we overlap. So here's what angel investors are looking for. What problem are you trying to solve? Okay, we've seen a lot of really cool technologies looking for a problem. It's not how it works. If there's a problem, you use the cool technology to solve it. So how is your product or service going to solve this problem? Why do you think you'll win? That's the secret sauce that angel investors are looking for, to see whether you've got that product market fit that you can drive to make a repeatable business model that will get that next stage funding from an institution to scale. They're looking at the market opportunity. Now, most companies will never scale. That's okay. You make a nice little business, so don't bother us. Okay, that's just the way it goes. Real customer pain that can be solved. We need a competitive advantage. And we need a management team that knows how to devise a strategy and execute. Remember what I was saying, a strategy is nothing unless it's executed well. And this is where you need a good operational framework to do so. Then, why are you talking to us? What do you need from us to succeed? Is it money? If so, how much? And for what purpose? Is it our networks? Who do you want us to connect you with? For what purpose? And most important, This is why we're angel investors. How much money do I make? And when do I get my money? So here's our statistics that came out of the Angel Resource Institute. It's the research arm of the Angel Capital Association, of which we're, a lot of us angels in this town are members. But this is what they're really thinking. This is really important. If you want to know what sort of points they are putting on the entrepreneurs when they're evaluating you as to whether they will invest or not invest, that's it. See the amount of points that they put on the management team, the ability to strategize and execute, the size of the opportunity. It better make a whole whack of money for us. Otherwise, don't bother talking to us. And everything else comes second. All right, it's a two-way street. So you need to do due diligence on the investor, because we had questions during Jonathan's talk about should we have a board member? What about this? What about that? You need to find that right alignment with your own interests. So look to see if there's an area of business focus. I'm a life science gal. I know drugs. I do drugs. I know it didn't sound quite right, but if you ask me to do a B2C Facebook app, I really don't have much to say. Location. The earlier the company, the closer geographically the investor would like to be, because they like to be within an hour's walk, bus, car, train, or plane ride away. Because in the early stages, when an investor is trying to help you turn your business model into something that is repeatable and hopefully scalable, there's a lot of back and forth and a lot of advice that they give you, because it's not just money that angel investors give. They give that advice and the connections. And the stage of investment. Too early, too late. Sometimes if you're in the fortunate position where you are already mature, don't bother coming to the angel investors, because they're just going to give you money and be along for the ride. They don't have much value add. Too early is not good either. It has to be just right, just like Goldilocks. Expertise, this is where you need your value add. See if there's a potential conflict. Look at their portfolio. What's the available capital? Angels do like to invest in tranches. You want to be able to have them with you as far as you can. So they would do some follow-on financing. No different than venture capitalists, just in smaller amounts. And the reputation. And if you talk to other entrepreneurs who have dealt with investors, you can pretty well find out whether they are helpful or not helpful. Understand the deal process. This is every angel investor has a deal process. This is not e-funds, but it's pretty similar. So it's a process. Don't expect that you will have the check written in your favor just as quickly as you got it from Aunt Doreen. Once you understand where you are in the ecosystem, how you fit, all the pieces come together for you, including the money. So I'll just give a little bit of commercial about us before I close off. The Entrepreneurs Fund, we're a bunch of people that have been in this business for a long time. We have been entrepreneurs. We paid very expensive tuition to be angel investors. This is our portfolio so far. If you go to our website, you'll find out a lot of about our investee companies. And you'll notice that it's a really wide variety, because the way we work is that it's the investors in our fund that actually choose the investments. They identify a company that they like, they gather their fellow e-fund investors, and they do the due diligence, and then they make a recommendation to the rest of us as to what they invest. You will never find me on a due diligence team for lithium-ion ultracapacitors, but if it's about drugs, I'm there. And these are the investments from our predecessor funds that have given us some exits. So what's it like. Espriva gave us 24x inside 3 years. Valacor gave us 4x inside 12 months. And Equinox just filed their IPO on the NASDAQ. So we'll find out in about 6 months' time as to how much money we've made out of it. So with that, I'm going to conclude, and I think we're going to start the panel.
Yeah.